Good afternoon and a very warm welcome to everybody. I'm Chris Dines, Chief Executive of Informed Funding. We exist to provide better information, guidance and education on the increasingly complex world of business finance. And if you go to www.informedfunding.com, you'll find a wealth of information on different forms of finance and access to something like 700 different funders. As many of you might know, we hold a lot of live events, but this is actually our very first live webinar. But if it goes well, then we'll be doing quite an extensive series. The advantage for us, obviously, and for our many visitors to the site is that we can make the recorded session available to anyone at any time. So on to the subject for this evening. Tonight we're focused on whether you as a business are generating cash from sales quickly enough. And in particular, cash from customers who are much bigger than you. I'm always amazed by the fact that SMEs are nowadays net lenders to high street banks, which is probably something not everybody is aware of, but perhaps less amazed that SMEs are typically net lenders to big corporates. And the fact is that a cash-rich corporate demands increasingly tough credit terms, and a bit of data you'll see later. You know, many big corporates will take 90 to 120 days to pay out. So it's a constant theme that big businesses pay slowly, and despite some government sympathy, this situation has actually got worse over the last couple of years, not better. So what can we do to improve this position? What can businesses do to help themselves? Well, hopefully our speakers this evening can assist. So I'm delighted to say that we'll be hearing from Saraj Sal at Experian, who'll be looking at how you should monitor your own business creditworthiness, but also, very importantly, how you can assess the payment performance of your current and prospective customers. We then have two businesses which are relatively new on the scene, two alternative funders that can convert your good quality business into cash very rapidly. So we'll be hearing later from Oliver Cummings at MarketInvoice and Jack Trowbridge at GapCap. Now, a quick note on format. Each of our speakers will be presenting for about 10 minutes, and after they've completed, we'll have an open Q&A session, which I will be running. So it'll be myself as chair asking the questions of our speakers. I've already been sent some questions, but as participants in this session, you can post up questions onto the platform. All right, so I'll see those coming in, and then I'll feed them to the various speakers to respond to. So you should see that on your screen. You can just simply type in a question, and we'll pick it up later in the session. Okay, so we'll be running through till 6 o'clock. So now, without any further ado, I'm going to hand over to Saraj Sal from Experian. Saraj.
Chris, thank you very, very much. It's the opportunity to speak today. My name's Saraj Sal from Experian National Teams working within their Credit Services Department. And I guess what Experian are trying to bring to the table today is to give you an indication of what we've seen change within the small business population over the past 5 years and really the entire business landscape. In addition to that, I'm hoping to go into what we can do to help SMEs access finance, to maintain those sales, but more importantly, to manage the risk of onboarding these big clients that may have an impact on your cash flow later down the line. So if we move on, what Experian has done is pulled information from their national business database, and that's given us indication of how businesses and the business population has changed over the past 5 or 6 years. Now, there's a lot of information on that slide there, but there's some key points to take away. The overall business population has grown by about 107%, but interestingly enough, certain areas which you may or may not have expected to increase or decrease have done so. There's been about a 570% increase in the number of human health well-being companies, companies such as people operating as dietitians, nutritionists, etc. Now, what we've seen post-recession is there's been an increase in sort of disposable income within families, and as a result, there's been a change in the business landscape to reflect that. A 470% increase in the number of retail businesses, whether that be on the high street, online, mail order or catalogue shopping, which is quite interesting. Now, as we move into sort of a more technologically advanced era, we've seen an increase in the number of hardware, software consultancy services. Now, that includes businesses who operate graphic designers, online marketers, search engine optimizations, etc. About a 240% increase in that sort of business population. Now, interestingly enough, what we generally class as our large multinational limited companies or PLCs, generally your manufacturers, your wholesale of textiles, chemicals, metal ores, etc., seen a decrease of about 30% in that business population. So in a nutshell, we've generally seen an increase in the number of service-based companies, a decrease in manufacturing, etc. Now what we've seen, well, the increase in those three areas there, are typically your small SMEs, your sole traders, your individuals who have found it easier to set up a company online and are working from home. And it is these people who now need access to finance. So really, what is it that the government are doing to help support SMEs access finance? There's three key points here. Initially, government obviously looking to improve small business access to finance by removing certain legal barriers or legal restrictions. Secondly, looking to incentivise businesses to improve their payment policies and practices. And finally, to improve the ability of challenger banks and, of course, alternative finance providers to conduct accurate risk assessments. Now, there's a few key points to note here. See, the introduction of the prompt payment code is now putting the responsibility on the large businesses to ensure that they're paying their suppliers and their customers, regardless of their size, on time. And you may or may not know, yesterday Experian were actually given designated status. Now, this relates to a small group of credit referencing agencies in the UK who are now set to receive credit data from certain banks and lenders, including VAT information, all commercial credit data, which will serve to promote competition in the UK SME market in terms of accessing finance. And secondly, access to that sort of data will therefore allow lenders and alternative finance providers to produce better credit assessments on SMEs and sole traders, hopefully allowing to increase the amount of information or the amount of loans we're able to provide. So we've seen what the government are looking to do in order to support SME access to finance, but the onus generally sits on the small business, the sole trader, the proprietor, the director of that small business. Now, what Experian have done back in June 2014 is launch a product called My Business Service. Now, there are numerous services out there on the market, but what we're aiming to do is provide access, help directors and business owners to really understand, to improve, to monitor their credit risk. Interestingly enough, 1.9 small businesses within the UK don't understand how to view their credit score or how to protect their credit score. We've done a little bit of analysis on that within the company, and about 40% of small businesses have ever checked their credit score, and only about 44% of those have done so in the last 6 months. So what we're actively trying to do with the Experian is to promote this, to make sure small businesses are checking their credit score, so when they are approaching lenders, when they're approaching large companies to onboard them as suppliers, customers, or to access finance, they're portraying themselves in the best light. So what will we see as a result of this sort of information that you can look at through the Experian system? What it will give you an indication is what lenders, what alternative finance providers see on you as a small business when looking to loan. So you'll get an access of everything that Experian hold on you in terms of commercial keys data. So we do a lot of work with banks and lenders who supply us information to suggest how not only small businesses but large businesses are paying their leasing contracts, their phone contracts, their mortgages, their utility bills, etc. You'll have an indication of all public records available, document images, but more importantly, all of the data assets that Experian use to calculate your business score as an SME or a sole trader. And that's obviously something that we will sit down with you as a business owner and talk about to rectify if there are any issues at all. Now, finally, and probably the most important piece of information you'll see within the My Business Profile setup is payment data, trade payment data. Now, what Experian have done, have produced a payment performance program which collates sales ledgers from up and down the country of various clients. Now, what we often find is account information is submitted by Companies House. driven into the Experian system, but typically that account information will be out of date a few months after a submission. So the most accurate, the most live and up-to-date information we can have to determine a company's cash flow is trade payment data, how that business is paying their suppliers, how that business is paying their customers. And what you can see there from the second box from the bottom is that 82% of companies with a turnover of £40 million have got average accounts outstanding of £100,000 or less. That's an awful lot of money that's out there with the likes of you guys, SMEs, sole traders, and large limited businesses, outstanding accounts. So what we are trying to promote is businesses to really get a good idea of what they're getting into when onboarding a customer or supplier. And that comes down to key due diligence. So within the Experian system, you're able to access credit information on businesses, but one of the most important pieces of information around there is payment data. And what you can see on this slide here is the payment profile. If we look at the bottom left red circle, what that gives you an indication of is this company are paying their accounts size between £1 and £1,000 118 days beyond terms. Standard terms are typically 30 days, they may well be 60, but this entity are paying them 118 days beyond terms. If we scoot over to the right-hand side there, the right-hand box, for £100,000 plus accounts, this company are paying those 60 days beyond terms. Now, this is pretty staggering, but not uncommon, unfortunately. What we generally find is that larger companies are much, much slower payers. There may be many, many reasons for this. A lack of accounts payable resource, a lack in operational efficiency, or simply just reputation, prestige. The company always pay their large accounts on time. The smaller accounts aren't quite as important, hence they get pushed down the pile. And that's really what we're trying to promote. As an SME, if you're looking to get into business with these large companies, these large corporates, you really need to have an idea of how you're likely to be paid before exposing yourself, and that potentially have an impact on your cash flow. Now, what you'll see just under the days beyond terms figure, halfway up that slide, is that through accurate due diligence, we can get a really good idea of what the payment pattern of this company is. So if we look back on April 2014, this company were paying on average 23 days beyond terms, and that equates to the industry average of 23 days beyond terms as well. You'll notice from April 2014 onwards, up to December 2014, the average days beyond terms of this company have slowly increased up to 79 days beyond terms. The industry average has remained relatively stable, but these guys are paying a lot later. That may indicate some sort of cash flow problems, and having access to this sort of data from the onset will allow you, to a degree, to dictate the terms when you're dealing with a company of this sort of size. So in summary, what we're really trying to do at Experian is to give an indication of the resource and help that's out there for an SMEs to seek funding and to lend. I'm sure Oliver from MarketInvoice, Jack from GapCap will go into this in a little bit more detail. But from an Experian perspective, what we're trying to do is to educate small business owners, provide them with the guidance to understand how your business looks when you're approaching a lender, when you're approaching an alternative finance provider, how to manage and how to improve your credit score, and ultimately to see the information that's publicly out there on your company. And finally, we really can't stress this enough, is to do active due diligence, to understand your clients, your suppliers, your customers prior to onboarding them, whether that be taking trade references directly, looking at payment performance information, or using any raft of suppliers out there to determine the credit profile or the credit appetite of those sorts of companies. I'm sure there'll be some questions towards the back end of this presentation, but that's a wrap from me. Thank you.
So, Raj, thank you very much for that. Just goes to show how much you need to think about all the sort of data held on you as a business, which people access. So I'm sure we'll come back to that later. So now we're going to the first of our two short presentations on sources of finance, which can help you convert your trade position, your sales position into cash more quickly. So delighted to invite Oliver Cummings from MarketInvoice to come onto the call and to give some background on MarketInvoice and what they actually do for businesses. Oliver.
Hi, Thank you very much for having me. Hello everyone on the call. So as I said, I'm Ollie. I'm Partnerships Manager at MarketInvoice. So first I'll go through the kind of problem. You've heard about the kind of fact that businesses are paying, later. Well, what we see is with the larger businesses, particularly, they actually at any one time can owe about 32 billion to SMEs. That is, you saw the stats before about 23 days actually ended up being 50 to 70 days, and actually if you put that into an amount that is it's about 32 billion. That changes obviously, but it's a pretty large figure. And 41% of SMEs say their main worry is cash flow, which is a very stark issue, and something that has obviously been a problem since a lot of the banks have squeezed on how to get overdrafts and other funding facilities. So we are one of many companies that have come into the market at the moment about how to give you alternative sources of funding to help your business. And so who are we? We are a completely flexible selective invoice finance service. At the moment, we've traded over £550 million worth of invoices. That's over 8,500 transactions to date, and we've served and helped fund over 1,300 clients, and that's all been without any form of banking money, and that's all been to companies that may not have got that finance from any other place. We are a marketplace or peer-to-peer funded, and we are the largest invoice finance platform in Europe. And what's quite interesting is the British Business Bank have funded us up to 10 million. So when you're trading with us, you actually have quite a large percentage of your invoice funded by the government, because we're working very closely with them on how to help companies get their cash quicker for their invoices. So I thought I'd go straight into a quick case study, and just a quick example. We do, as a company, we're extremely strong with exporters, and at the moment we're advertising on the Tube in London, you may have seen, so I thought I'd use those examples. Scaramouche and Fandango are a male grooming company, and what they are selling a product to Selfridges and Selfridges style companies all around the world, all through Asia and America, Central Europe, and they basically are just finding those type of clients, the large companies they're selling to, are just paying them extremely late and with really long payment cycles, and they found it was really hurting their growth. So they just started using us, and we could fund them. We could fund countries that no banks would go to, and perfectly sensible companies are very big. Perfectly sensible countries are very big companies, and so we've now helped them grow the business, and they're extremely supportive of what we do. And so the second one is another example of Fishrod. This is a creative company that just basically make very cool advertising and marketing products. But if you look at their balance sheet, all they are is a few Apple Macs and a rented accommodation. There's actually no value to their company whatsoever, other than their ability to produce revenue with their creative ideas. And they struggled with their growth because they couldn't find any way of funding themselves. No bank would look at them, couldn't get any form of overdraft or traditional invoice finance facility. But they had really good revenue, making thousands and thousands of revenue, but they couldn't find anyone to help fund them. So as we looked at, our risk model was very happy with their ability to have their debtors pay, and so we could help that company grow. And it's just a good example of MarketInvoice helping a company that really wouldn't have been able to get very good sources of funding previously. And so how we funded, what's very interesting is we don't use any form of banking money. We are very much marketplace lenders. A common word used at the moment is peer-to-peer. So where money comes from British Business Bank, we've got pension funds, high net worth individuals, hedge funds, family offices. So we've basically got a selection of very sophisticated investors that believe in our story and put money onto our platform. So there's plenty of money, and we can fund invoices within 2 hours. So it's a very quick service, and the access to capital is extremely quick. So how are we different? Only 5% of the UK SMEs currently use invoice finance, when we first came into the market, we were very concerned this was a very low figure, and we wondered why such a powerful product of invoice finance, such a clever idea, use your current revenue to fund your business, and why it had such low adoption rates. And we just found the old product was just riddled with so much customer pain points that we just thought, when we come into this market, because we started the alternative finance, selective invoice finance market, we just said we would eradicate these issues. And so first we did it with complete flexibility. We don't set up a contract with you. You can trade invoices as and when you choose. There's no form of lock-in. We don't charge you if you don't trade an invoice that month. You can come and go as you please. It varies as and when you want. We can actually fund you within 24 hours. The quickest we've done is 90 minutes, but that was a very unusual case. We're happy to do it within 24 hours. Transparency. You can see our pricing on the website. We give you the pricing. You'll always know exactly how much you're paying in the future, and there'll never be any form of additional prices come to you. There'll be no additional fees, nothing like that. And stress-free. Well over 80% of the customers that we trade with are trading without a debenture or personal guarantee, so we can happily trade with companies and fund their invoices without any form of onerous charges over their company. So who are we helping? We're helping a whole set of high-growth SMEs throughout all different industries. We help with the Growth Accelerator, with TechTrack 100. I think there was a stat last year that we were helping 5 of the top 10. We currently in last Sunday, we're listed as the 7th highest growing company ourselves, so we are now in the top 10. And so if you just go on to the next slide, just to show just a quick rundown of some sectors that we're now very strong in that wouldn't normally have thought of invoice finance. So just the one before, so there's the export world. We can trade with many different countries that banks wouldn't approach. And in construction industry, we've had a fresh look at the construction market, and we can fund through almost all different stages of payment. And also, we are very strong within the media and technological fields because we can happily fund very asset-light businesses. We've also introduced a contract finance product where we can also advance up to a year of a software as a service license or some other type of contract. And so why are people using MarketInvoice? So we've got a lot of data now. We've got over 1,000 clients, over 8,000 different sources of transactions. So people are using us to grow their businesses. They're using us to increase stock levels, obtain better terms with suppliers, offer better credit, hire more staff, launch marketing campaigns, and enter new markets. Lots of people come to us and say, we're thinking of going into the German market. Can you do these invoices? And we're like, of course you can. And then we fund them entering the German market, or it could even be South America, anything. We're very happy to help in export. And we have, along with trying to keep the pain points down, we've got integrations of all the major software cloud accounting services. Where we've got Xero, work very closely. We're a key partnership with Sage, along with Funding Circle. And we also have Cashflow on board. We're currently coding to have QuickBooks on, so we'll be able to use them as well. So that just means our application process only takes 2 or 3 minutes, and then we can come back to you with a funding line in 24 hours. And our risk model, we have no legacy issues like the bank. We do a completely footprint-free credit assessment of the company. There's nothing ever left on their credit score, which is very different to some other funders would provide. And we can use our large amount of data and our technological expertise to really see whether the company's working well and whether we can fund with them. And our fees, as you know, traditionally invoice finance can have a bad name for lots of different fees. We keep this extremely transparent. There's no onboarding fees. There's no fees when you come on to use us. There's only 2 fees: upfront fee when we give you the majority of the money, and then an interest fee for our investors when we return the final bit of cash for you. And those are the only 2 fees you'll see, and you'll know exactly what they are before you start the trade. And just a few. If you go onto our website, we've got plenty of literature all about the world of funding and alternative finance. A bit further down, I did put our fees on, and that's just to show how transparent we are and exactly what you pay, and the fact that we have a very dynamic pricing model. So if you're over 7.5 million company, after a certain amount of trading, you'll be paying an upfront fee of 0.19, and then between about 0.4 and 0.7 a month for your invoices. So that's going down to APRs of less than 6%. So we have a very solid business model to help companies at a very low cost. Thank you very much. I think I kept to my time. I'm happy to answer questions afterwards.
Thank you very much, Oliver. That was great, and well done for battling through a bit of a cough as well. Yes, so we'll be taking questions after we've heard now from Jack at GapCap, which is another business which provides solutions in this market. Jack, over to you.
Evening all. Yes, so I'll keep it short and sweet because Oliver from MarketInvoice has explained the alternative finance market pretty well and where GapCap and MarketInvoice sit within it. But what I thought I'll do is I'll just use the old school technique of the funnel approach, where you start on a wide basis and move into more of a deep dive on GapCap, who we are, what we do, how we go about it, and how we're slightly different. So first of all, on alternative finance, I think it's pertinent to say that nowadays the likes of the MarketInvoices, the GapCaps, the funding circles, your Lend Invest, your Archovers are put in the same breath as the JP Morgans of the world likewise, because alternative finance really has started to take momentum in the market and is becoming more and more, that question of can you call it alternative anymore? And the figures speak for themselves. As you can see, the European alternative finance market has grown 144% from 2013 to 2014 and onwards. And for once in our lives, the UK seems to be at the front of the queue with a 74.3% market share, which just goes to show that alternative finance has really started to take a grip, and SMEs are starting to find alternative means of gaining finance, which is important. And as Experian are showing, where our risk models are growing, and we're lending safer and safer more and more. Moving on just quickly into GapCap and what we do. I always call this the new kids on the block, although we're more established than that now. We've been going for about 18 months, and we're in a similar space to MarketInvoice. What I mean by that, we're a selective invoice financier. So a traditional invoice financer would take the whole balance sheet sales ledger and fund against that balance sheet, meaning that if you've got your Morrisons, your Waitrose, your Sainsbury's, your Tesco's and your Aldi's, they'll look to take it all on board, whereas the likes of GapCap and MarketInvoice can simply sit on a Morrison's debt or an Aldi or Waitrose. It's very much a selective means. What this allows is for an SME to be able to pick and choose which invoices they fund and when, meaning that they've got great flexibility on their cash flow, and it means that they're not tied into anything, which in this day and age is quite a key selling point on the product. And it allows people to dip dive, especially seasonal businesses, when their cash flow is becoming slightly tight. At GapCap at the moment, we're seeing it's been a big month simply because Christmas is coming around and everyone's having that one seasonal order where they think, crikey, my cash flow is a bit tight. I'd like to finance just this one big order, and it's where GapCap are becoming prominent in the market. And so we're going for 18 months. I get mocked in the office when I use this analogy, but we start off with a few jabs, then some uppercuts, and now we're starting to do some knockout blows and really competing in the beauty parade with the MarketInvoice of the world, who do a great job and educate the product fantastically. I can't escape when I'm on the tube home. So that's what we do. If I give you a quick assessment of how we go about it, we've got a platform whereby you can upload an invoice and the risk team immediately assess it. Now, when I say we're a selective invoice financier, people automatically presume that we're in a peer-to-peer market. Now, we're not. We're set up as a fund-based product, which means that our capital is sitting there on tap, which means we can underwrite an invoice straight away, whereas the likes of the MarketInvoices will be back-to-backing, and they use high net worth individuals to effectively purchase an invoice. What that means is that we're effectively lending our own money, so we have a risk head who sits there, and we call it the smell test, whereby, yes, tech is important, but we also have a human influence on how we go about assessing our risk. So that's the initial assessment, and then from there we like to process the deal within 48 hours. I noticed that Oliver mentioned theirs was 90 minutes. We managed to do a 26-minute one last week, albeit repeat business, which I'll probably have to add before I get slated for it. But that's the way we like to work. We're pretty fast, and we're flexible, which means that because we're not a huge conglomerate and because we're not so the market invoices of the world yet, it allows us to be able to look at every deal and look to be more boutique on it, which means that we take a very much a personal approach on things, and we like to talk to clients and understand who they are, what they do, what their problem is, and if we can offer a solution. And on that means we've been starting to work with the banks a lot. What it allows is something called collaborative finance, which we're starting to home in on, whereby we're going to work with the banks and say if they've got a full ledger facility, we're looking to be able to share that debt, say to just one single debtor where the bank might be too heavily concentrated on. And what this allows is for the SME to stay happy on their full ledger service, the bank to keep their clients, and for GapCap to simply sit on that one debt. And it's something that we're actively pursuing, and that's where our flexibility really works and helps us out. As I said, moving on, where we're going in the future is we're looking to really help the SMEs on the seasonal side of things, and offer a playground for SMEs whereby they can come in, test their cash flow, look at whereabouts on their balance sheet they're struggling, come in and invoice finance against those particular invoices, then move up to more of a full ledger basis. I know Oliver's touched upon the ins and outs of the market, and he said that 5% are using selected invoice finance at the moment. We're looking to change that because it is a fantastic product. And the SME market are there looking for finance, and a lot get turned away by the more traditional methods, and it's where both GapCap and MarketInvoice are looking to help those out. I suppose I probably don't want to go and bore you because I know that my presentation might sound quite similar to Oliver's, but happy to answer any questions in light to both selected invoice finance and how GapCap might differ to others in the market.
Jack, that's tremendous. Thanks very much. And yep, all the presenters stuck to time and schedule, which is fantastic. So now we've got the chance really to sort of fire away questions, which can be, as focused and as detailed as you like. Now, if you're on this webinar, you'll need to type in your question if you haven't already done so. I'll see it popping up on screen at this end. We've got a number of questions which have come through before the start, so I'm going to kick off with some of those. So, first of all, I think this question which just far to Oliver at MarketInvoice. So you're providing support to a smaller business, and they're looking to effectively convert a sale to a bigger customer into cash. Do you check with the bigger customer whether they're definitely going to be paying the smaller player?
Sure. So we've got a product called Verification Cloud, where basically the customer can email the end user, the client can email their customer, and basically they can verify it lightly there. We can do that on an undisclosed nature, where it looks like it's just credit checks from the company, or we can actually do it where we actually say they're using MarketInvoice. So a lot of the time, now with the scale that we're receiving now, we're actually starting to work with a lot of larger companies in the UK particularly. So we are kind of aware of whether and how to work with those companies. So a lot of the time it can be light touch. Other times that we know that the end users are perfectly happy speaking to us. But it's all done by very light email or through online portals.
Okay, so there's no risk underlying that to the smaller business?
No, if they're very, very sensitive to not wanting their clients to know that they're using, an invoice provider, we're obviously one of the few that's very happy to go completely shadow as far as working with them. We generally get them to just do an email like they're getting a quick check, so we do have some form of validation from the client.
Yeah, okay, because I think that's the underpinning reasoning behind the question, that nerves that you're using such a facility.
Yeah, and that's one of the big things that we're in as the market leader, we're in a big thing to promote, and hopefully everyone like GapCap will gain from this in the sense that we're looking to make. We've even had people from places like Bibby say that this is affecting the market. That MarketInvoice is driving the idea that it is a perfectly acceptable form of growth capital to use an invoice finance product, and it is in no way seen, traditionally in invoice finance, particularly full ledger products, that was seen as potentially a negative thing, and the company was struggling with their working capital. We're on a big campaign to show that this is actually a perfectly sensible way of growing your business by using, equity investment, things like that. It's actually a very expensive form of finance. Getting term loans is a very controlling finance. This is a short-term and quite adequately cheap way of getting finance.
Okay, good. Taking another question, it's sort of similar vein. I think this is really for Siraj at Experian, which is a lot of big companies, corporates, will do some form of due diligence on their suppliers when they go onto their process platform. In other words,
sure.
you can't even get into the bigger customer and be a supplier until you sort of go past various checking levels. The issue of sort of credit scoring and referencing and how strong you are as a business, what should the business think about? What are the key items they should be getting right in terms of their sort of checkable, referenceable information on their finances?
Sure. So I guess one of the key points around this is initially an SME actually logging on and understanding and checking their own credit score. Within the Experian system, what you will do is get access to exactly what that large company will see. Now, we've got a team internally within the My Business profile set up who will sit down, actively work with SMEs to help build those credit scores. And the key things that we generally try and promote are use of credit. Don't be scared to use credit. Active credit accounts paid on time will be beneficial on your overall credit rating. If you actively do not use credit or are not trading on credit terms, then that may have a negative impact on your overall credit score. So don't be afraid of opening credit accounts. If you're unable to get access to credit, or if your credit score is low, then as I said, we've got teams who will work with you to help you build those scores internally.
So borrowing's good on that
Borrowing
basis.
is good. Exactly.
As long as you stick to plan. Okay. If you think your references on your file, etc., you think they're unfair, how can you go about changing those?
So one of the key pieces within the My Business profile piece is alerts. So as soon as we receive information, whether that be trade payment data, information from company's house, or commercial keys data, credit account information sharing, you as a business owner with your My Business profile account will receive that alert immediately to suggest that Experian have got access to that. We do complete quality control of all that information that's come through, ensure it is correct, ensure it's non-biased, before uploading it onto your credit report and having an impact on your credit score. We've obviously got a dispute team internally. If you feel information hasn't been portrayed correctly, then we will remove that from the limit, we will remove that from the score, actively go in and investigate that in a little bit more detail, because of course we completely appreciate, much like the consumer world, it's a very, very sensitive nature providing credit scores and credit limits, and we want to work with you as an SME, as a business owner, to get that right from the onset.
Okay, got you. Question which really I think maybe both Jack and Oliver could answer, because there may be different answers possibly depending on your business model. But Jack, if you using your software, what happens if the customer, the corporate doesn't pay, either because they've run into financial trouble or because they're unhappy or disputing? What happens in that scenario?
Well, we credit insure on all our deals, so we wouldn't go against the debt unless we were credit insured, and the client is immediately brought under GapCap's policy in regards to that. And so if there was a dispute, then the first protocol would be to claim on our credit insurance, and that is our first safety net when going in against disputes from from a big debtor, and both our credit insurers and our lawyers have larger, more bite than bark, to put it that way. And so that would be our first port of call. And then second of all, now MarketInvoice touched upon when they said that 80% often don't go to debenture or personal guarantee, and we're in a similar vein whereby we only go and get extra security against a client, whether if there's an extenuating circumstances. But if we do have security such as debenture or personal guarantee in place, then that would be the second port of call. We haven't had a bad debt yet, and I hope not to ever have to do one, because whilst I like our credit insurers, I never have to pick up the phone and tell them to go hunting for me, because that's something where my premiums will start to go up. So that would be our path, as it were, in a bad debt situation.
Okay, and Oliver, is there any difference with the way MarketInvoice approaches things?
Well, yes. So we don't generally credit insure our clients. We leave that up to them. We work closely with the major credit insurers, and we can offer good rates if they want to do that. But we can find that quite expensive, and they don't really insure many things, and we find it can be quite heavy disputing. What we generally do is we work very closely with the client, and we are always knowing exactly what's happening and seeing when the clients are thinking of paying and whether they're late paying. So in that kind of situation, we find the easiest thing for us to do is we actually just move that debt onto another invoice at no charge to the client. So they can just basically put that onto another invoice, and it all works the same. And once that invoice is paid, it's all settled up. On a very, very infrequent occasion, we've moved it into a term loan, where we've just given them a kind of interest-free term loan just to make sure they can pay it off, where it becomes almost like a funding circle situation. That's kind of how we work. And what the main thing for us we all do is very, very case by case. We always work with what the client wants and what they're kind of working to achieve when they have one of them. A lot of the time that could be their major client has gone into trouble.
Yeah. I mean, Oliver, you've obviously done a lot of business now over the last 3-4 years.
Yeah.
Are you able to say what sort of percentage of the business does go into bad debts or partial bad debts?
I can say that. So obviously our risk model is quite robust. We've done 550 million worth of borrowing so far, or given borrowing to companies. We've lost less than 0.5% of that. So because that our system of light touch around changing its different invoices is very effective.
Okay, so
so I can't really give you an exact figure, because there's what's quite interesting is over 8,000 transactions now. We've got a lot of this kind of data, but it's very much kind of for us to make sure we improve our product and make sure we're helping clients further.
Right. Okay. Possibly this is something which Suraj might be able to answer, which is in a lot of sales agreements, contracts, it's often quoted that you can charge interest on late payment.
Sure.
Do people actually? How often are people actually able to charge late interest, for late payments?
Sure. So, I mean, I understand you can obviously claim interest or debt recovery costs 30 days generally after the customer gets the invoice or you deliver the goods. Now, in terms of the actual success rate of charging interest, it's not something that our payment performance data would show. I can definitely go away and have a chat with our payment performance team to find out if it's information we can collect. I couldn't sit here and tell you whether or not it is successfully charged or not, unfortunately. But I don't know who's fed that question in, but if I relay that answer back to you, Chris, I'm sure we can pass that on.
Because I think it's a practical. I don't know whether that's a question which either Oliver or Jack can answer, actually.
Yeah, well, I mean, a lot of the people we talk to are obviously very David versus Goliath in their relationship with their suppliers. I would be very interested to see that happening. I've not seen it myself, but in this day and age with lots of companies bringing out later payment terms, if the company is that confident in their product, then potentially there's a potential chance to ask for that. But it's I suppose managing the relationship, it's a reasonably risky step.
Yeah, I tend to agree with that. I'm yet to see it see it myself either. But it, it could come around the corner if it is a risky step, but it could work, I suppose.
I think it was sort of fanfared and trumpeted by the government, wasn't it, a few years back that you should be allowed to do that and follow through, but I suspect it just largely doesn't happen. But moving on to kind of slightly more specific questions. Company with a question that they've got very limited trading history. How's that perceived by yourselves, Oliver, first?
Is that the client or their customer?
This would be your client having only 1 year's worth of trading history.
Yeah, sure. So obviously, as a growth company ourselves, we're extremely keen to work with growing startups. So what our two criteria to be able to fund a company is obviously they need to be a UK or Ireland limited liability company, but they need to have 100 grand in their last year's annual accounts. But if they don't have annual accounts and they're very young, they need to have 50 grand evident within their last 3 bank statements. So if they can prove that they've got 50 grand in the last 3 bank statements coming from invoice-based activities, without any form of trading history, it could only be 4 months old. We are happy to fund those clients as long as their customers are appropriate.
Okay, so that's suitable for actually very small companies on that basis, isn't it?
Yeah.
Jack, are you any different?
We are slightly different because we credit insure. Our angle is very much on the end debtor, meaning that we don't actually have a 100k annual accounts kind of protocol which needs to be hit, or 50k evident in the last 3 months. We're very much on how the end debtor looks in this scenario. I mean, the perfect example is we had a client 3 months back. It was a lady up in Yorkshire who had a jewellery line, and she had great success, and we managed to get to one of the high retails. It was ASOS, and she managed to get into ASOS, and we were very happy to give her an invoice finance facility simply because we looked at ASOS and we had a credit insurance limit within that. So we work very much on the angle of how much we can get, what limit we can get on the end debtor, meaning that we can take any client of any size as long as the end debtor is reputable and we're happy to work within their remit.
Okay, interesting. Next question relates to the relationship with banks. So a company already has an overdraft and loan facility in place. Mm-hmm. Does that preclude them from going to a MarketInvoice or GapCap? Maybe Jack, could you just sort of comment first? Maybe how does that work? Presumably this is a company which might have a bank charge over its various assets.
Yeah, well, that's something which we see a lot, especially working with the banks, and it's a very easy scenario whereby we simply get the debenture waiver in place. I think I touched upon the example in my presentation, but if, say, if the bank has a charge and the client is going to say Waitrose, Sainsbury's, Tesco's, Morrison's, and Aldi, and GapCap want to come in and sit on the Aldi debt, we simply waive the debt from the bank and then take our Aldi debt out. It's called carving the debt out of their book. And the banks, we work with we haven't had a bank manager who refused yet because they want to keep their client happy. So what we do is we waive it out, and it's a very simple procedure. And it's not just the banks. Secured loan companies are doing it as well, which we work with. And you're able to carve out the debt and be able to keep funding the client on a selective invoice finance facility. So it's and I presume it's probably similar to what Oliver's probably going to say the way MarketInvoice worked. If not, I'm interested to see how.
Cool. Yeah. So Ollie here. We have obviously relationships with all the major high street banks and all the other different funders. Depends on the strength of the debenture that the bank has. We would either have a conditional or temporary carve out where we would carve out the invoices or the particular debtor or kind of certain funding amount. We've got all those different scenarios agreed with all the banks. Also, particularly strong debentures with venture capital, private equity, and some kind of banks as well. We would generally do a deed of priority, which just means is we come in with them for the amount that we are lending at any one time. So because we're dealing with quite large businesses as well as small businesses, we've got quite a lot of different options of agreements we can sign. Sometimes when a bank's got a lot outstanding on a large overdraft, they would rather go into a deed of priority.
Just a follow-up question, Oliver, from me on that. So some of this is quite complex stuff, isn't it? Do you do the checking and the work on what the current charge position is
Yes.
with the company?
Yeah, we do all that, and it's all free. It's all part of our service to get a client to trade with us. Most major banks, because we've been working now for quite a few years, have standard templates signed that we just send to the client, and they're filled out very quickly. So there's very few banks now that we don't have kind of templates in place with those banks.
Right. Okay. So it process-wise can be quite swift, this sort of interaction with the bank situation.
Yes, it can take no time at all. So I mean, we have classic examples where like someone like Lloyd's will come to us and say we can't do this Chinese debt, and we'll just carve out that particular Chinese or Asian debt that they just have within their legacy rules. They just can't go there. That happens quite often because we've got such a strong exporting product that they know that now, and they just go to us for those invoices.
Okay. Oliver, sorry, picking on you again. It's your fault for having put a slide up with charges and interest charges.
No worries.
So how does the interest charge actually work? So I'm just trying to interpret the question here. So is it based on the sort of monthly balance or?
Yeah. So what it is so you have the upfront cost, which is within kind of size that you are. Then you have the discount fee that ranges from 0.4% every 30 days to about 1% every 30 days, and that accrues on a daily basis. So if you pay it back within 15 days, you just pay half. If you pay it back within 45 days, you pay 1.5. There's no early or late payment fees. It just accrues on a daily basis at the rate that we've quoted. Right.
Okay. And how does it compare to the type of charges you might expect with sort of traditional invoice factoring?
Yeah, so with regards to traditional invoice factoring, sometimes they can have slightly lower fees. They generally can't within our gold and platinum band. We're always going to be cheaper at that point. But the fact that we don't have any form of other fees whatsoever, a lot of times with traditional invoice finance guys, you're going to have an audit that costs about £500 a few times a month. You're going to have minimum service contracts, so you have to pay a certain amount each month whether you trade it or not. Also, they charge for kind of back fees. We've done some projects into this where we've tried to work out all the different fees to make it comparable. But it's very hard. Those kind of traditional guys actually make half their money on their fees that they don't initially tell you about. So it's actually a very complex thing to compare. The main thing for us is we try and keep our fees as low as possible and as flexible as possible.
Right. Okay. Just time for just a couple more questions. One, I think one of you in your presentations mentioned contracts, and in a situation where you have a contract where you get paid on account, which would happen quite frequently for businesses supplying a particular service to big corporates. So you might be paid sort of 10% up front and then a percentage part way through the project. It's a bit like a construction contract, I guess. Is that something which GapCap can handle?
Yeah. It's effectively what you're touching upon, a stage payment, whereby someone's on a project and they have their payment coming in various stages throughout the project. That's something we're happy to do. We look at it as individual transactions along the project. So, for example, if you were doing 10%, that's 10 individual transactions and 10 individual invoices we fund. And we're happy to sit on that and go off on that. And what you're probably alluding to there is the construction industry, which work on a lot of either subcontractual debt or on certified application for payments or uncertified. We would prefer to go on a certified application for payment, but we're able to go and do that instead of effectively going in against an invoice.
Actually, this is on looking at this. Would be actually on a consultancy type contract.
Okay. Yeah. So an advanced payment.
Sorry,
Oliver. You crack on. What was that?
Ollie.
Oh yeah. So this is it was probably alluding to the fact that we've just introduced this new system where we can now do contracts, not stage payments. They've always been happy to do certified and uncertified stage payments. This is actually doing things like software as a service licenses or other form of contracts. We can now go up to a year in advance of the actual services being done. So say if you've gone into Microsoft to do a consultancy project with them, that you're going to do something for them and they're going to pay you monthly for the next 3 years for this service, we can actually advance the first year of that now, even before you've done the service, which is kind of the first to market on this style. And we've launched it about 3 months ago. It's gaining a lot of traction in particularly the tech market, where all the kind of things, services, the kind of SaaS stuff or all other kind of as a service products come in.
Okay, that's really interesting. I'm sure that's of interest to a lot of tech businesses. Yeah. Okay, so I think we have to wrap up now. I was just going to, as chair, ask one final different type of question to each of you. Very, very swift answers. Which is, why do big companies and corporates take so much credit? It's they're frequently sitting on a lot of cash. What's the fundamental reason, Saraj? What's your view?
I think, like we said earlier, running back to late payment, what's the reason behind big companies paying so late? It's prestige. It's because they can. If they don't have to tap into their cash reserves and they can access credit accounts and maintain that cash flow, I guess that's probably one of the main reasons why they do that, because they simply can.
Okay. Oliver, Jack, anything to add?
Yeah,
Oliver first?
I'll crack on, Oliver.
Well, I'm now thinking about Douglas Adams' Hitchhiker's Guide to the Galaxy, about the kind of issues of bureaucracy within big companies. But that, I would say, it's more just because they can. Until they're told they can't. We've got a lot of innovative tech companies that are actually getting much better payment terms because the companies know that they cannot use anyone else, and they'll be very, very, they really do need this product. But we just find a situation where they're just in a stronger position than our clients, and they can just get better days, and they're too important for that client for the client to give up on them.
Yeah, got you. And Jack, any final comments from yourself?
Yeah, I'll join the bandwagon by saying it's simply because they can. But I think what's important to touch upon as well is that there's a lot of demand and a lot of supply out there for the bigger guns in the market. So if you take Sainsbury's, for example, and you're a potato supplier, then there's a lot of people who want to supply potatoes to Sainsbury's, so they can simply either up their payment terms, knowing that if someone moves off Sainsbury's, they've got a lot of supply where someone will come on in 30 days or 60 days or 90 days. So it's about the supply and them knowing that they can bully the market, knowing what they can get because there's so much demand to go into the big players.
Got you. Good stuff. Okay, look, we're going to wrap up there, and thanks ever so much to Saraj, Oliver, and Jack for your input. Very insightful, very helpful. I hope everybody's enjoyed and sort of learnt some different aspects coming on to the session. If you've got further questions or queries or want to find out more, do go to Informed Funding on the platform. You can raise questions there, or indeed you can contact our speakers on this session directly through the platform. And finally, please do sort of fill in some feedback. I think there's a little feedback thing you get when you close out of the session. So thanks very much again to everybody, and have a good evening.